Welcome to Good Money Moves, the show where we share financial tips and advice to help you feel financially empowered. I'm Jenna Taubel, AVP of Marketing here at First Alliance Credit Union, and joining me today is Jackson Cameron, our home lending advisor here at the Credit Union. We are going to be talking all about a very important topic that we get a lot of questions about because it's not something that everybody is familiar with. It's not necessarily like a basic money management skill, but it is an important tool to help you meet your financial goals, and that is using your home's equity. Talking about home equity loans versus home equity lines of credit and how those two things differ, how they're the same, and how you can use them to help you reach your financial goals, and which is why I have Jackson here with me today. So before we dig into the topic, why don't you just share a little bit about yourself and what you do here at the Credit Union? What is a home lending advisor?
Yeah, so I've been at the Credit Union for about 3 years now. A home lending advisor, we take care of second mortgages and manufactured housing financing.
Awesome. So the perfect person to be here talking about
That's
this
right.
today. Awesome. Well, let's dig right into my first question, and that is, what is home equity, and how can someone kind of get an estimate of what their home's equity is?
Yeah, so home equity, basically the amount that you have on the mortgage minus the what it's worth on Zillow. So if you're looking for a good estimate, you can go on Zillow and kind of just do that, the math on what you owe on the home versus what the home is worth.
Yeah, and then so you subtract those two and you get your equity, what's left.
Correct, yep.
So kind of the portion of your home that you actually own.
Correct.
Yeah, so I like to call that what you owe versus what you own. And you take those together and you've got your home equity. So when we're talking about a home equity line of credit, a lot of times you'll see that abbreviated as a HELOC, right?
Mm-hmm.
Just for anybody who's not familiar with that. A lot of times HELOCs come with what's called a draw period on them, which is different than a home equity loan.
Correct.
So can you talk a little bit about kind of the line of credit versus the loan and what some of those differences and similarities are?
Yeah, so our home equity lines of credit are a 20-year amortization, so it's a 10-year draw period, meaning you can use the funds like a credit card for 10 years, and then a 10-year repayment period after that if there's still funds owed. Fixed home equities, they offer a little bit of a lower interest rate, and the payment will be a little bit higher, but you're able to pay that down quickly with a lower interest rate, and that rate will never change. The home equity lines of credit do have a variable rate.
Okay.
The floor rate for us is 3%, and the ceiling is 11%. But it will only change monthly if anything were to happen with the Fed.
Sure. And would you say, so the home equity loan is that fixed term, so that's why that rate's not going to change.
Correct.
Whereas the line of credit has a more variable rate, similar to a credit card, right? If you have a credit card, your interest rate's going to go up and down kind of with the market. So the home equity line of credit, because it operates similarly, is going to have that rate change alongside it and kind of have a little bit of variability in that.
Yeah, the easiest way I tell people to think about it is just one big fancy credit card that just uses your home as collateral. So.
Yeah. Well, okay, so I'm going to back up a second. You said the word collateral. Can you talk a little bit about what that means?
It means we're just taking your property as a security interest and giving you the funds, so that way it's beneficial for both us and the member to be able to give funds out to you.
So it's basically saying you have this home and you want to use this equity, so it's almost like a second mortgage in a way?
Yep, second mortgage is perfect way.
Okay, perfect. So I mentioned draw period a minute ago, and so I want to bring that back up when we're talking about home equity lines of credit. Can you talk a little bit about what that draw period is typically, what that means, how that works?
So yeah, payment is 1% of whatever you draw out, meaning so you're not going to pay interest on funds that are just sitting in your account until you pull it out.
Okay.
The minimum payment's going to be $100, but then again 1% above that on the repayment.
Okay. And then when would you say a fixed home equity, so home equity loan, makes more sense for a borrower over a home equity line of credit and vice versa?
Yeah, so I would say fixed home equities are really good for debt consolidations because we're dispersing the funds right away and you're paying that lower interest rate. HELOCs I definitely recommend for like any construction, home repairs, things like that, where you don't have a specific timeline on when you need the funds, so that way you're not paying interest, especially if you don't know the exact amounts.
Okay.
So those are more beneficial for like those home improvements, roofing, things like that.
Okay. So a fixed home equity loan is better, it sounds like, for things where you know exactly how much money you need to take out, whereas the home equity line of credit is, for there's more variable expenses, or maybe there's going to be expenses that kind of happen one after another.
Yeah.
And are you able then to kind of draw on those funds with the home equity loan and pay it down, then draw it back again, just kind of a revolving?
The fixed home equities, those are fixed, so the funds are dispersed either to pay off debts or just to your account right away, and then you would just pull those as needed.
Okay. So it kind of sits there until you use it, but it's not necessarily something that replenishes.
No,
the same
it's
way
a one-time
goes.
deal, unlike a home equity line of credit.
Perfect. So how, if home equity lines of credit have more of that, credit card style way that you manage that budget, how would you maybe help somebody plan for those variable expenses in their budget, like to make sure that they can afford, like even if they were to draw that full amount, make sure that they can still afford that payment versus maybe if they're only planning to use half of it at some point?
Yeah, that's a good point. So we typically recommend people plan on using the full amount, so the full budget. So say you take out a $100,000 home equity line of credit, you're not going to use it for about a couple months, and you're only going to draw out $20,000. I would budget for $1,000 a month because that's what it's going to be at most, and that's what we also underwrite off of is the max payment. So we make sure that you're protected with your finances and that you know what you're going to be paying.
Yeah, and then I would imagine on the reverse side, the home equity loan, that fixed type of loan, you're going to know what your payment is right away.
Correct.
That's not going to change. It's not going to be fluctuating
Correct.
the same way.
Correct.
Home equity
Yep.
line.
We'll send you all sorts of estimates, disclosures, things like that, even before closing, so that you're very. You know what you're signing. You know what you're doing. So.
Yeah, of course. Yeah. Well, so you brought up closing, which makes me want to bring up, closing costs. You hear that a lot when you talk about buying your first home. Mm-hmm. Talk a little bit about that when it comes to doing a home equity loan or a home equity line of credit. What does that kind of look like? So
a lot of people think it's pretty expensive. It's really, really not here. We don't charge any origination fees except for our bridge loans. But so the fees would include services. So that's things like the title pull, property condition report, automated valuation. We don't do full appraisals to save some money for our members. And then the flood report. Okay. And those generally come out to $231. And then there's county mortgage recording tax at 0.23%. So those are the only fees. Generally, I see fees from $400 to $1,000 being the most. And those can be wrapped into the loan as well.
Okay. So you said a lot of words. What's an appraisal? An
appraisal just someone will come out to your home, do like a full walkthrough, get the full value of all your appliances, everything that's in your home. And if there's any renovations that the county doesn't know about, that's a good way to get more value. But what we do is an automated valuation. So that just takes comparable homes for sale in your area with like the square footage, lot size, and then we get an estimate based off of that.
So, and that's a step that has to happen for a home equity loan or a home equity line of credit to ensure that you're getting the right value assigned to your home, so we know how much we can actually give you in a loan. Okay. And so one thing I often hear when people are talking about home equity loans and home equity line of credits are like you can take out a loan to value amount of like 80% or 90%. What does that actually mean?
So so it's the amount of equity that you still have left in your home. So typically, most financials don't like to go above 90%, although we can do it based on different circumstances. Basically, it just means we want to make sure that everyone's safe and protected. You don't want to be upside down on your home.
Yeah.
So we only borrow up to that 90%, meaning, how do I want to put that? You're just borrowing up to what you have left on the mortgage. So you just got to subtract that out. And the main reason is to protect the member and us, to make sure that you're not upside down, and then we're safely giving funds out. Yeah, you're not being stretched too thin. You want to make sure that you have a little bit of wiggle room left in your budget, left in your equity. Yes. It's just a good protection for both sides of the transaction. Absolutely. What about like credit score, income? Does that play into, or how does it play into your ability to get a home equity loan or a home equity line of credit? Are they the same kind of factors? Are they different? We underwrite off the same principles. At first glance, we take a look at the full financial picture versus just, lending in a box. You have to have this score, and this debt to income. We do have typical guidelines of a debt to income, about 50% or below, and that's pretty standard as far as all financials. But again, we can work with, different situations as a case-by-case basis. We don't have any credit score requirements. We just take a look at the whole picture, we see all walks of life, and we listen to your story, and we understand. So we'll take a whole look at everything and see based off of that.
Yeah. I'm glad that you brought that up, because that is a huge differentiator between First Alliance and a lot of other lenders, is we have that ability to be a little bit more flexible in that regard. And then the credit score comes into play really more for a rate.
For pricing.
Yeah. So you talked a little bit ago about how you can use home equity loans to do debt consolidation. How does a situation like that work?
So it can happen in one of two ways. We can have the member pay the debts off themselves if they feel more comfortable. Otherwise, we can just do it all for them. So we'll just grab most recent statements and we'll just pay it all off for you, and they don't got to worry about it. And then you're done, and you just make the payments monthly, and there's no worries after that.
Awesome. So they just come in, sit down with you. You look at all the different debts that are there, kind of add them up and go, okay, this is the amount you'd need to pay these off. We'll issue those final checks out and make sure that it gets done properly, so you don't have like a couple cents left over somewhere by accident.
Yep.
And then instead of making all these different payments across different, credit cards or different billers, it's just you start making that home equity
just
payment
the one,
instead.
and you just worry free pretty much.
Perfect. And this is getting a little bit off topic, but I know you'll know the answer because you've been here long enough. Is home equity always the best tool to use for debt consolidation?
Not always.
Okay.
It's going to give you the best interest rate, though, and the most friendly repayment terms. So we can be a lot more flexible on that, on the mortgage side of things.
So when would debt consolidation and home equity be the right combination with each other? In what scenarios typically?
I would say if it's large amounts of debt, because you don't want to be paying a higher interest rate on a small amount of debt. So if you want to do like an unsecured loan with just like $10,000, I mean, that might be more beneficial for, the process is a little bit quicker on the unsecured side. Yeah. But I would say when you have a large amount of debt that you just want to get rid of.
Yeah, well, that makes a lot of sense. Yeah, because you wouldn't want to have that higher interest rate on top of all of that additional debt. It just would make a really large, expensive payment versus if you've got the equity in your home, that you'd have less interest to pay on that large amount of debt that you're trying to whittle down more quickly. That makes a lot of sense. Let's talk a little bit about what happens, because I know this would probably be a fear for some people. The housing market fluctuates. Up, down, up, down. What happens if home values drop and you have a home equity loan on your property?
So the rate won't change. If they drop, you'll just want to make sure you get that paid down as quick as possible, so you're not upside down in your home if you do ever want to come to sell it.
Okay. And then are there any, whether at First Alliance or other lenders, are there any other fees outside of closing costs that people should be aware of when it comes to evaluating home equity loans? And, if there's one place that may be better value than another to get a loan at?
That's really it. The only thing that can fluctuate is the services, so that can change by maybe $10 to $15 just based on where the member's home is located.
Okay.
So no fees, no origination costs on the home equity lines of credit or home equity loans.
Awesome. So how long is the process from the time that the member applies for the loan to the time that loan closes and the funds are in their account to start using? What does that timeline look like? What are some of the steps in the process that go along with a home equity loan application? We talked a little bit about appraisals being part of that, but what else from start to finish? So
from origination to closing, we normally say around 10 to 15 business days. So it's around 8 business hours to know if you're pre-approved or not from our underwriting department. And then again, that next amount of time is just getting that flood report ordered, the title pull. We're a lot faster than a lot of other financials. A lot of other financials are taking 30 to 45 business days to get things done for you, and we can do it in about half a month. So it's really only a few steps. We'll just get permission to order those services, and then it's just we wait and get it done for you.
Awesome. You guys work quick.
We do.
That's awesome. So to help make this process go even smoother, it sounds like you guys are already a pretty well-oiled machine. What are some of the documents that someone would need to bring in during a home equity loan application?
Yeah, it's really simple. We'll just need your current IDs, government-issued IDs, and then your 30 days of income verification, whether you're paid biweekly or weekly. If you are a self-employed borrower, we'll need your 2 years of tax history. And then your most recent mortgage statement if you have one.
And that's the same whether it's a loan or a line of credit.
Correct.
There's no difference there. Awesome. So what are some other things that you feel like our members should be thinking about or considering before moving forward with a home equity loan or a home equity line of credit? Like, what are some of the things that people don't always think about when they're considering this tool?
The biggest one I would say is remembering that it's not tied to your first mortgage, so the payments are going to be 2 different payments. So just making sure that you know that it's not affecting your first mortgage and you still have that additional payment. That's really the biggest thing I would keep in mind.
Yeah, that's a great point, because I can see where you would think, well, it's all using the same piece of collateral that we talked about earlier, so why wouldn't they be together? But that's a great point. Anything else that our listeners should really know when it comes to home equity loans, home equity line of credits, how to choose between one if you're not sure what the right path is for you?
I would say, again, if you're just looking to use funds in the future, maybe the home equity line of credit is in your best interest. But if you just want a one-time, one and done, maybe the fixed home equity would be the best for you. It's not as scary as a lot of people make it seem.
Yeah.
It's a pretty quick process. We take care of everything, and we're always there to answer questions for you. So.
Awesome. Well, thank you so much for being here. This was amazing. You're a font of knowledge. We will definitely invite you back again. I feel like there's so much more we could talk about, dig deeper. This is such a big topic to cover, but we are out of time. So thank you so much for joining us. This has been Good Money Moves. If you want to learn more about home equities, home equity loans, lines of credit, how to use them, how to apply for them, you can visit our website at firstalliancecu.com. And until next time, stay financially empowered.